The Fed's final monetary policy meeting of the decade gets underway tomorrow. Brian Cheung joins us for a quick preview. So, Brian, we just had the BIS come out with a big paper on the repo markets, which Chair Powell got a lot of questions on at the September meeting. That was right after the initial sort of blow up there. And then again in November. It seems like this is the issue that's not going to go away. Is there, in your mind, some sort of satisfactory answer Powell could give markets to let them know that repo activities are not QE4?
I mean, not really. And probably, I think the jury will be out through the end of this month, right? Because people are saying that there's another test this month in December because you have a lot of banks trying to close their year-end position, show regulators as of the December 31st, 2019 date that they are in a good liquid position, which means that they could be hitting the repo market pretty hard as they did in September again as well. But I think for the meeting on Wednesday, the press conference, he'll have the opportunity to talk about that. It's no surprise that the central bank is going to want to shift the blame onto the private sector, right? But at the same time, the private sector, the banks have been pointing the finger at the central banks as well. I think this is going to be a running theme. The central banks are going to say, look, this is a few players, probably the four largest banks that just decided they wanted to swap in cash for treasuries, and oops, everyone's rushing to funding at the same time. Whereas the central banks are saying, whereas the banks themselves are saying, actually, this is a regulation problem. The liquidity requirements are too tight. The truth is probably somewhere in the middle there.
So we get to talk to you after the meeting, and you have been able to ask a question.
Right.
And by the time you talk to us a little bit about your strategy, because sometimes your question gets asked by the time it gets to you. So if you got to ask your first question, we want to make sure you get the opportunity, because it's probably going to get taken, but we want you to get the credit. What do you think is the most important thing to ask?
Okay, so we need to set up the ceteris paribus here, which is holding all else equal. If the Fed does keep interest rates the same as we expect them to, ceteris paribus, keeping all else equal. But if they don't move on rates, that means the current range would stick at 1.5 to 1.75%. Okay. My question would be something along the lines of, well, the dot plot projections, and I haven't seen them yet. There's probably going to be a few members, and say probably more than 5 or 6 that will probably signal maybe one rate hike next year. My question would be, what would it take to actually, put into place a rate hike next year? By the same token, if it seems like the median dot, which is unlikely, but if it were to be the case that the median dot would signal maybe another easing next year, then my question would be, what's the threshold for that, right? Because regardless of where you stand on whether or not the next move is going to be a rate hike or a rate cut, the Federal Reserve has signaled that it's going to be a high bar. It's going to be a high bar to move in either direction. So what exactly is that bar? On the downside, is it inflation that would be, nudging up against 2.5%. And it seems so unlikely, but if that were to be the case, would that be the standard for you to need to hike rates? So I think that would be my question.
All right.
Great.
Brian Cheung, next time we talk to you, you'll be on a phone in Washington, D.C.
Yep. See that?
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.